Most people hear about Forex trading and think it's some kind of secret way people make money online. You've probably seen screenshots of traders showing big profits, flashy cars, or claims that you can turn $10 into $10,000 overnight. But here's the truth most people won't tell you. Forex trading is not a get-rich-quick scheme. It's a skill. And just like any skill, if you learn it properly, practice it, and stay disciplined, it can become a powerful way to grow your money. So in this video, I'm going to give you a complete beginner guide to Forex trading in 2026. By the end of this video, you'll understand what Forex trading actually is, how people make money from it, and the exact steps beginners should follow to get started safely. Let's start with the basics. Forex simply means foreign exchange. It's the global market where currencies are bought and sold. For example, when you travel from one country to another and exchange your money, that's Forex. But in trading, it happens digitally and on a massive scale. In fact, the Forex market is the largest financial market in the world, with over $7 trillion traded every single day. Banks trade currencies, governments trade currencies, companies trade currencies, and today, retail traders like you and me can also trade from a laptop or even a phone. Now the big question is this: how do traders actually make money in Forex? It's very simple in theory. You're basically betting on whether one currency will go up or down compared to another. Currencies are traded in pairs. For example, Euro/USD. This pair compares the euro to the US dollar. If you believe the euro will become stronger than the dollar, you buy the pair. If the euro rises, you make a profit. But if you believe the euro will become weaker than the dollar, you sell the pair. If the price drops, you make a profit. So in Forex, you can make money whether the market goes up or down. That's one of the reasons why people are attracted to trading. But there's something beginners must understand. Forex trading is not just about clicking buy and sell. You need a system, you need discipline, and you need to manage risk. Before you ever place your first trade, there are three important things you must learn. The first is understanding currency pairs. There are three main types: major pairs, minor pairs, and exotic pairs. Major pairs are the most traded currencies in the world. Examples include Euro/USD, GBP/USD, and USD/JPY. These pairs usually have the lowest trading costs and the highest liquidity. That's why beginners are usually advised to start with major pairs. Minor pairs are currencies that don't include the US dollar, like Euro/GBP. Exotic pairs involve smaller economies and tend to have higher risk and wider spreads. So for beginners, sticking to major pairs is usually the safest place to start. The second concept you need to understand is something called pips. A pip is simply the smallest price movement in most currency pairs. For example, if Euro/USD moves from 1.1000 to 1.1001, that is one pip. Your profit or loss depends on how many pips the market moves and how large your trade size is. This is why risk management becomes extremely important, which brings us to the third concept beginners must understand: leverage. Leverage allows you to control a large position with a small amount of money. For example, with 1:100 leverage, a $100 deposit can control a $10,000 trade. That sounds powerful, and it is, but it's also dangerous, because leverage magnifies both profits and losses. This is why many beginners lose money. They use too much leverage without understanding the risks. Smart traders focus on protecting their capital first, because if you lose all your money, you're out of the game. Now let's talk about how traders actually decide when to buy or sell. There are two main ways traders analyze the market: technical analysis and fundamental analysis. Technical analysis means studying price charts. Traders look for patterns, trends, and indicators to predict where price might go next. You might hear things like support and resistance, trend lines, moving averages, or candlestick patterns. All of these tools help traders understand market behavior. Fundamental analysis is different. Instead of focusing on charts, it focuses on economic news. Things like interest rates, inflation, employment data, and central bank decisions.
These factors influence the strength of currencies. For example, if a country's economy becomes stronger, its currency usually strengthens as well. Many professional traders combine both technical and fundamental analysis. They understand the economic direction and then use charts to find good entry points. Now let's talk about something that can save beginners from losing a lot of money, and that is the demo account. A demo account allows you to practice trading with fake money, but in real market conditions. You can learn how the platform works, test strategies, understand how trades move, and build confidence without risking real money. This step is extremely important. Too many beginners skip the demo phase and jump straight into real trading, and that usually ends with losing money quickly. Professional traders treat trading like a business. They test, they practice, they improve. Only then do they scale up. Now let's talk about the biggest mistake beginners make in Forex trading, and that mistake is overtrading. Many new traders open too many trades. They chase the market, they trade out of boredom, or they try to recover losses quickly. This emotional trading is one of the fastest ways to destroy an account. Successful traders are actually very selective. They wait patiently for high probability setups. Sometimes the best trade is no trade. Another key habit of successful traders is risk management. A common rule many professionals follow is the 1% rule. This means they never risk more than 1% of their trading capital on a single trade. So if you have a $1,000 account, the maximum you risk on a trade is $10. This protects your account from large losses, because even if you lose several trades in a row, your account can still survive, and survival is the most important part of trading. Now let's talk about if you're completely new to Forex. Here is a simple path you can follow. Step 1. Learn the basics of how Forex works. Step 2. Open a demo account with a regulated broker. Step 3. Practice trading and learn chart analysis. Step 4. Develop a simple strategy. Step 5. Start with a small amount of real money and focus on risk management. Remember, the goal in the beginning is not to make huge profits. The goal is to become a consistent trader, because consistency is what eventually leads to profitability. Forex trading can be an incredible opportunity, but only for people who approach it with patience, discipline, and a willingness to learn. If you treat it like gambling, you'll lose. But if you treat it like a skill that improves over time, you give yourself a real chance to succeed. And remember this, the traders who win in the long run are not the ones chasing quick money. They are the ones who focus on the process, learning, practicing, managing risk, and staying disciplined. Because in trading, success doesn't come from one lucky trade. It comes from hundreds of well-managed trades over time.